Well, I'll stick to what I said when it was under 1300. I said we're going to get to 2536. 2536 isn't that far away now. It's a couple $100 from where we are today. On what's happening with the BRICS, and again, I'll eat these words if we get through the fall and it's not shown to be this. But I think we're going to realize that part of what's driven gold has been a movement that's going to come out for these countries to trade among themselves and also others with some form of gold backing whatever they end up, how they trade, whether digitally or physically or a combination of both.
As global economic dynamics shift, gold continues demonstrating its enduring value as a safe haven asset. Recent comments from Federal Reserve Chair Jerome Powell suggesting a potential easing of inflation have led traders to anticipate an interest rate cut as early as September, contributing to gold's recent price stability. PeterGrandich, a seasoned financial commentator renowned for his expertise in precious metals, forecasts gold to reach $2,536 per ounce shortly. This prediction aligns with gold's historical performance, which has outpaced stocks and bonds since 2000. From 1971 to 2020, gold boasted an impressive average annual return of 10.6%, often surpassing traditional assets, particularly during inflationary periods like the late 1970s and early 1980s. Grandich's bullish outlook on gold is partly attributed to the growing influence of the BRICS nations and their potential plans for a gold-backed monetary system. This development could significantly reshape global trade dynamics, requiring Western nations to increase their gold reserves to maintain economic partnerships with BRICS countries. The article, Founders, the BRICS will use a gold standard underscores this shift, suggesting that Western nations may need to either accumulate more gold or restructure their supply chains to reduce dependence on BRICS resources. This geopolitical realignment could further bolster gold's position in the global financial system. Recent data from the World Gold Council supports gold's relative strength in the current economic climate. While yields on U.S. government bonds saw a slight decrease of 0.2%, and global government bonds, excluding the U.S., experienced an average loss of 5.81%, commodities in the U.S., including gold, gained 5.83% in value. Please tune in for our exploration of PeterGrandich's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
Peter, what's your take on gold?
Well, I'll stick to what I said when it was under 1300. I said we're going to get to 2536. 2536 isn't that far away now. It's a couple $100 from where we are today.
Yes.
I think the more important thing about price is why has gold performed as it has, and why still have most investment advisors not embraced one of the three tier one investments you can have in the world? People got plenty of stocks, they got plenty of bonds, but they have very, very little physical gold in their portfolios. Yet it's the only one of three tier one investments you can make in the world. I think the reason is, and we're going to see it, and I'll come back and be the first to say I was wrong, but I think we're going to see a lot more advancement of the BRIC nations and where they're going as these fall meetings come together. And I think we're going to get a real minimum hint of how gold may play a role.
Price this past
Yeah.
year?
Yeah, David, I believe it's the single biggest reason. I think there's more, but believe that's the single. And that's the reason why they can't take it back down, Dave. As you and I speak here today, we had another article again. Oh, the Chinese didn't buy and they took the market down 30 something dollars. They did that a month ago and just going higher than that in a couple of days. I believe the same will be the case here. The physical ownership desire for gold is surpassing the normal plays that are played in the paper market. And the key part of that is because gold's trading has moved away from the London, New York environment and to Asia and Shanghai. And that has really changed the perception and the reality of how gold trades. And and let me add this, because I used to get picked on because I never said the same positive things about silver, but right now silver has as good an argument in my book as gold does. So I think both of them will continue to perform well. And let's remember this, David, despite what all these other people like you to think, since the turn of this millennium, gold has outperformed stocks and bonds.
Talking about since 2000.
Since 2000. And if you really want to go, if you go back 50 years or so when gold started free trading, it's now outperformed bonds.
Okay.
And yet, if you talk to any so-called typical financial advisor and said, I was thinking about gold as an investment or an income thing, they would say, you're crazy. You should own bonds. But meanwhile, listen, it's always going to be the Rodney Dangerfield, get no respect kind of investment. But I would just tell you this, I would not want to see most people that I meet, from working class right up to the athletes I dealt with, not having at least some gold in a portfolio. And let me tell you why. I always tell them own some and hope it doesn't go up. And Dave, they all say the same thing. Mr. Grandich, why do you want me to buy something that's not going to go up? And my answer always is the same, Dave, because if it goes up a lot, chances are what you own a lot is going to go down. And I think gold minimally should be treated as an insurance policy. And yet most people have no real insurance.
Is there something different now with the way gold is behaving?
It went up without getting that merited increase in chatter and talk and recommendations. It's still not. Most portfolios that are put out by the major brokerage firms have little or no gold ownership in it. It's gone up because people who recognize on what's happening with the BRICS, and again, I'll eat these words if we get through the fall and it's not shown to be this. But I think we're going to realize that part of what's driven gold has been a movement that's going to come out for these countries to trade among themselves and also others with some form of gold backing whatever they end up, how they trade, whether digitally or physically.
U.S. stocks reached new record highs on Wednesday, fueled by Federal Reserve Chair Jerome Powell's testimony to Congress and continued strength in big tech shares. Powell's remarks suggested that the central bank is moving closer to cutting interest rates from their two-decade highs, citing moderating inflation and a cooling job market. The Fed chair's cautionary note about the potential economic risks of maintaining elevated rates for too long further bolstered investor sentiment, as many have eagerly anticipated a shift in monetary policy. This optimism was reflected in the broader market, with significant indices pushing to fresh all-time highs. However, not all market observers share this bullish outlook. PeterGrandich expresses a bearish view of the stock market's long-term prospects. While acknowledging the current rally, Grandich is more concerned about a potential 30 to 50% decline over the next 3 to 5 years. Adding to these cautionary voices, Morgan Stanley's chief investment officer, Mike Wilson, predicted in a Bloomberg TV interview that a 10% decline in the S&P 500 before the November U.S. presidential election is highly likely. This forecast introduces an element of political uncertainty into the market outlook. Let's get back to the interview.
David, I mean, I am bearish, but I think that's kind of a vague way. That's fairly, how many months away, and there may be a 10% correction. I don't know if that's a market forecast. I'm from the
Okay,
old school, my friend. I don't know the gentleman, so I don't want to pick on him or anything.
sure.
He might be phenomenal. My feeling about the market is this: if you're interested in the next few weeks or few months, I think that's anyone's guess. I think flip a coin, do what you want. If you want to start talking about multi-years out and resort back to what a stock market ultimately is, which is where you buy part ownerships of businesses, and those businesses will mostly do well or not so well depending on economies, then I would say I'd be quite bearish because I think things are going to get a lot worse economically, socially, and politically. So I'm not so concerned about the next 10% or 10 weeks. I'm more concerned about the 30 to 50% over the next 3 to 5 years. Probably one of the primary reasons to be at least concerned, if not outright bearish, the lack of following and improvement as those few stocks went up 8 to 9 out of 10 times proved troublesome down the road. But I'll tell you what I've seen that I've never seen before in my 40 years. Given where market prices are, where valuations are, and given what the mood of the market is, the complacency among investors and the so-called professional public, with all the fundamental economic and social factors that one could argue that are as much bearish as they can make an argument of bullish, the fact that there's such a complacency and not a real fear at all that I see at all, even at these high valuations, suggests that what normally succeeds over time, contrarianism, is the thing to be, and be contrary to the popular opinion now that this market's going to just keep going up and up.
Right. Is this reminiscent of 2000 for you?
Well, the only difference is between 87 and 2000 and 2008, there was the ability for the government to step in and bail out if we have a crisis. We no longer have that availability because we became so indebted and we're spending so much money each year more than we have. we will not have the ability to simply print 5 or 10 or 15 trillion, whatever it takes to whatever ends up happening, and have the market accept that as that's a net positive. That's the big change now. And one of the big reasons is one of the 5 reasons of my Build the Ark is that political paralysis. David, here in the US, I can only address in the US, Democrats and Republicans cannot go in a room and make any worthwhile legislation anymore. And on top of that, they each have a faction in their party that wants to move more extreme away from their center. So I don't believe if and when the next crisis comes that there's the political will to fix it this time. So in the 40 plus years, I've seen 3 major financial crises. Each at the time was perceived as a major crisis, even though if you look at 1987, when the Dow was just a few thousand points, you would say, what big deal was that? But for that time, that was a significant financial crisis. Same thing in 2000 and 2008. But each time, the main thing that turned the turnaround for the market was the Fed acting in a much easier stance, creating all sorts of additional money and, of course, debt creation. The governments can no longer do that without fear because people have come to the conclusion that we're now getting to the point we may not even be able to make our interest payments. So that card that was readily available in those last crises, I don't believe is going to be readily available for the next one.
Given the current economic landscape, including potential interest rate cuts, BRICS nations' influence, and political uncertainties, how are you balancing your investment portfolio between traditional assets like stocks and bonds and alternative assets like gold? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.